Rohit is very happy. That is because he's looking to buy a new house. Rohit calls his CA, who asks him the reason for his happiness. Rohit told him that he's buying a house. On hearing this, the CA asked the details about the house. Rohit said that the house is in Ghaziabad and he bought it from an NRI. He further added that he got it at a cheap rate as the seller was in need of money. His CA congratulated him on a great deal but also reminded Rohit to deduct TDS, else there could be problems. Rohit inquired about what's the need to deduct TDS. Just like Rohit, buying a house is a dream for millions of people. If in this inflationary times you get a house at a decent price, then it's a pretty good deal. Many a times in such cases, people end up making a mistake. So let us see how tax is calculated when NRI sells the property. What should a resident buyer do when he buys a house from an NRI? There is a tax on gains when you sell the property, whether it is a local resident or an NRI. This tax depends on the holding period. If you sell a house after holding it for more than 2 years, then there is long-term capital gains tax. However, if the holding period is less than 2 years, then there is short-term capital gains tax. If an NRI gets a house as an inheritance from his parents or grandparents, then also there is a tax. If there is a short-term gain on the sale of the house, then the amount of capital gain will be added to the total income of the NRI in India and will be taxed as per the tax slab of the NRI. While on long-term capital gain, there is 20% tax after the benefit of indexation. In both cases, surcharge and cess are different. Like local citizens, NRIs can also save long-term capital gains tax under Section 54 of the Income Tax Act on buying a new house by selling their old houses. For this, you'll have to buy a house with a full amount of profit. New house has to be bought within 2 years from the date of sale, while its construction should be completed in 3 years. You can take advantage of benefits by buying a house even 1 year before the sale. As per Section 54 from FY 2023-24, tax exemption will be available only on capital gain is up to 10 crore rupees. You have to pay tax on gains above it. Also, NRI individuals can save tax under Section 54 EC by investing in select bonds like Rural Electrification Corporation RECL, Power Finance Corporation PFCL. The maximum investment can be up to 50 lakh rupees. Bonds should be purchased within 6 months of property transfer. Capital gains tax and rules for saving it are almost the same for local citizens and NRIs. However, there is a catch. Local person buying property from NRI has to pay after deducting TDS from the sale price. TDS is 20% on long-term capital gains while 30% on short-term capital gains. There is no limit for tax deductions. In contrast, there is only 1% TDS on buying a property from a local citizen if the sale amount is more than 50 lakh rupees. Certain rules are mandatory for a local buying a property from an NRI. Such buyers are required to obtain tax deduction and collection account number (TAN number) for deducting TDS. It has to be deposited with the Income Tax Department within 7 days from the end of the month in which TDS is deducted. TDS can be deposited online or through challan. After filing tax, the buyer has to fill the form 27Q and file the TDS. Finally, the NRI selling the property to the buyer will have to give form number 16A, that is TDS certificate. If the NRI seller feels that the amount of TDS being deducted by him will not be taxed, then he can apply for lower deduction certificate or nil deduction. You have to give application to Income Tax Jurisdictional Assessing Officer. For this, you will have to fill out Form 13. NRI has to calculate his total earnings in India along with capital gains. Also, a copy of the sales agreement needs to be submitted. Online application can also be filed. After this, officer will issue a lower deduction certificate. TDS will be deducted as per that. If just like Rohit, you're also buying a house from an NRI, then don't make any payment without deducting TDS. Else, you may get in trouble. It is more complicated to buy a property from an NRI than to buy it from a local resident. For this, you can take the help of a chartered accountant. If higher TDS has been deducted for NRI, then he can claim refund by filing income tax return. The amount left after adjusting TDS in the total tax liability will be refunded by the income tax department to the NRI.